In this video, I'm going to share with you 3 of my favorite tips that I use when I roll over my cash secure put options. By the end of this video, you'll know what cash secure put options are, but more importantly, you'll know how to roll those put options over, especially when they go deep in the money on you. I'm Randy Perez. I'm a 20+ year stock and option trader as well as real estate investor. This video about rolling put options is the first video in a 2-part series about rolling options. In the next video, we're going to discuss how to roll cover call options, especially ones that have gone deep in the money on you and they're in stock that you want to keep. But today's all about rolling put options. So let's get right into my first tip that I use whenever I roll put options. Now before we get going, I want to encourage you, if you have any questions, please ask them in the comment section below. Briefly, before I get into my first tip that I use when I roll put options, I want to make sure you know what put options are. When you sell a put option, you're selling someone insurance. You're selling someone the right to put stock into your account at any time between the day you sell it and the expiration date of the option. And they can do that at the strike price of the option. Now, if you're new to option trading, that may have hurt your brain when I just said that. So I'm going to leave a link down in the description below to a video that's a beginner video that will tell you all about the basics of option trading. But when you sell that put option, you're selling someone insurance and you're selling them the right to put stock into your account at a set price, which is the strike price, and a set time frame, which is between today and the day the option expires. All right, so we got the basics out the way. Now let's get into my first of 3 tips I want to share with you that I use every day when I roll options. What does it mean to roll an option? Here's an example of an option position that I rolled several weeks ago. And although I did this in one order, there were 2 pieces to this order. First, you see here that I bought to close the Hershey November 15th 180 put option. In order to roll it, notice in the line below that I sold to open the Hershey February 21st 170 cash secure put option. So I bought the November option back to close it out, and I sold the February option to keep this position going. I'm gonna get into more details about this exact roll in just a minute, but I wanted you to understand what it meant to roll a put option. So you're buying one back that expires in the near term, and you're selling one that expires farther out in time. If you've been around option trading for any amount of time, you've probably heard this term called the Greeks. This isn't the Greek people. Greek people are awesome. This is the Greeks when it comes to option trading. Here you see an option chain of UPS. Notice on this bottom right corner, we have a couple of the Greeks. We have delta and theta. When you sell options, it's important to understand what's going on with some of these Greeks. And the most important one, in my opinion, when you're selling options is probably theta. Currently, as you see here in the green row, I've sold the January 17th 125 put option. And notice in my portfolio tab here, it tells me the theta of that position is 0.019. Now what theta is, if nothing else changes with UPS between today and tomorrow, the value of this option will lose about 0.019 cents per share. Since I've sold one contract of this put option, you multiply that 0.019 times 100. And as you see here, the value of this option contract will lose almost $2 over the next day if nothing else changes with UPS. So that theta or time decay, it works in your favor. Just kind of keep that in the back of your mind as we go through this video. So you can think of theta kind of like as your buddy or your friend if you sold an option. So I've sold this January 125 put option that you see in this row right here. Another interesting column in this option chain is this time value percentage. So you see the theta is 0.019, but this time value percentage is 3.49. So what is that? That's actually my broker trying to annualize the return that I'll receive on that extrinsic value on the theta portion of this option. So saying that right now, this position where this option is trading at, I'll get about a 3.49% annualized return based on the 125 strike price. Now honestly, that's not that great. So can I do better? Well, here's where rolling an option comes into play. Let's look to see if we can get more money for rolling this option out in time. And here you see that 125 strike price. Notice if I go all the way over here to the theta column, that theta is higher. It's at 0.023. And notice the time value calculation or the estimated annualized return on this option. What's 7.16? That's about double what the one is for January. But what if we went farther out in time? What if we went out to April? Here you see we have that same 125 strike price, and notice what the annualized return is. It's actually less. It's only 6.17%. If I was looking to roll this option out now, I might consider going ahead and doing it because the return is better. There are more factors than just the return you want to consider, but if we were only basing our decision based on annualized return, well, March is looking pretty interesting right now. But before I forget, and before you say, hey, let's go ahead and roll that option, I want to tell you about a nasty little guy that comes around once every quarter, and that's earnings. If you're selling options, earnings can be a tough time. You see, stocks can get really volatile after earnings are announced. So if you're going to roll an option out, you want to avoid earnings, you want to avoid those expiration dates that will leave you in that position through earnings. But if you understand the volatility that can happen after earnings are announced, then you might consider going ahead and rolling it. And just to make sure you understand how this annualized return or this time value column is calculated, is based on the extrinsic value of the option. Let me show you how that works. Here you see the formula that the broker uses. So one thing I don't really like is that they base the return on the bid price when it comes to selling options. But if anything, I guess you could say that's a safe calculation. Here what the broker's saying is if we sold this 125 option, it's worth about 61 cents. Now I think you get in between 61 cents and 72 cents, but we'll go conservative and say you'll get 61 cents. So take 61 cents divided by the number of days left in this option, which if I slide this over, you can see there's 47 days left in this option. So it's 61 cents divided by the 47 days left in this option. Then to annualize that, we multiply that times 365. Then you divide that by the strike price of 125. When you hit the equal sign, you see it equals 0.037 or 39%. That's pretty close to the calculation they have here of 3.49%. I think the difference here is because we're on a weekend and the days don't quite add up with what was trading on Friday. So that's how they get the annualized return on these options. That annualized return is a nice way to compare the two different expiration days if return is your main consideration. So if we want to roll this option, all we're simply going to do is buy that put option back and roll it out in time. Let's say I was comfortable staying with the same 125 strike price. I buy the January back and I'd sell the March 21st 125 strike price put option. If we did this order, my broker is estimating based on Friday's close, I get about $2.43 per share for rolling this out from January to March. Here, notice it compares the theta for you. The theta of that January option is 0.019 per day. The theta of the March option is higher, so you get better time decay at 0.023 per day. So that's how you roll a put option out that you want to keep the position going in. Before I get to my third tip of how to roll a put option that's gone deep in the money on you, let me show you one that's gone your way. And we have one right now we're in with GL. So Global Life, ticker symbol GL, is a position where I've been selling cash secure put options in for a while now. As you see here, the stock experienced a sharp decline earlier this year, and since it's been working its way back up. So I've been selling put options against it because I thought it was undervalued. Now several months ago, we had sold the December $95 cash secure put option. Well, since that time, GL has continued to go up. It's been finding higher and higher support. Support's just areas where the stock tends to get bought up. So when the stock approaches that area, buyers tend to come in and buy the stock up. So support levels have risen over the past several months. So this is a position that I'd be comfortable rolling this put option up as I rolled it out. The 95 option has gone our way, so I could buy it back and sell an option, say, at a higher strike price of 100. Now I sold the December option, and because it's announcing earnings in February, which I like to avoid earnings if possible, I could consider selling the January $100 cash secure put option. And again, the reason I'm doing that is because GL has continued to go up and it's found higher support. Notice if we go back here to September, I wouldn't have sold the $100 put option back then because it reached a low of $99.04 per share that day. So I wouldn't have wanted to sell that $100 put option. I would have sold the $95 put option. But now we see it's finding higher support here. Notice this way back here in early October, it was finding support around $103 per share. Then fast forward to November 5th, and I found support at $102 per share. Since then, it's been finding nice support around $108 per share. So if I felt comfortable adding a little bit of risk to this trade, I could buy that $95 put option back that expires in December and sell the January $100 put option. If we go here to option chain on my broker account, you see the $95 cash secure put option, the annualized return is around 4.3%. So if we close it out and go to the January option, at the $100 strike price, notice that return is a good bit better at 5.5%. So overall, we get a better return for going out in time and also rolling the strike price up. But the only reason I'm doing that is because GL is finding higher support than it was when I sold that December option. Before I move on to my third and final tip of how to roll over deep in the money put options to get them back into your favor, if you have a comment or question, please leave it down in the comment section below. I try to answer all comments at least once per week. So please, if you have any challenges you're facing, please leave in the comment section below. And either I'll try to answer it or another viewer will try to answer it. How do you deal with those pesky situations where the cash secure put option has gone deep in the money? And it's gone deep in the money, you don't want the option assigned to you. Or maybe you're okay with it being assigned, but you want to improve your position. You want to improve the price that you're assigned the stock at. Let's talk about some ways to solve that deep in the money cash secure put option problem. Here you see one of my little problem trades I've been in over the past couple months. I don't have many of them, so I had to dig for this, but here's one. It actually isn't a problem for me anymore, at least at the moment, because Hershey has gone up. But it was a problem when I rolled this position. On November 8th, I rolled my Hershey position. And just so you get your bearings here, here's what the daily chart of Hershey looked like on the day that I rolled this position. Notice over the past several months, it had a sharp decline. In fact, it declined almost 15%. It was trading for somewhere around $172 per share to $175 per share on the day I rolled this position. So this one had gone against me. It had gone the money on me because as you see here, I had sold the 180 November cash secure put option. As you see on November 8th, that option was going to expire in about a week. Now I didn't want Hershey assigned to me, or if it was assigned to me, I wanted to be assigned at a better price. So what could I do to kind of solve this problem to help myself in a put option that had gone the money on me? Well, I just changed the game. I rolled the strike price down. 180 per share was okay if it was assigned to me. 170 per share, well, That was better. So I simply rolled the put option down. So I bought to close the Hershey November 15th 180 cash cure put option, and I more than paid for that by selling the February 21st 170 cash cure put option. Now I didn't get much for it. I got a nickel per share. So I don't think I can buy a piece of gum with that amount of money, but I did get a credit. So I was happy with that. I was happy because Hershey had gone against us. In fact, as you saw, it had declined 15% in the previous month or so. By selling this 170 cash cure put option, that option was now out of the money. So instead of being in the money by $5 to $8, it was now out of the money, and I walked with my big fat nickel. So I was happy. But how do you know when is the right time to roll these put options that have gone deep in the money on you? Well, if you don't want them assigned, you want to watch your extrinsic value. And that's what I do with my alerts. The way that I do that is I set an alert that the value of an option reaches a certain point, I get an alert on my trading platform. That alerts me to look at the position to see if I should go ahead and roll it if I don't want it assigned. As a matter of fact, as you see here, I have an alert set for the February 21st 170 call and 170 put option. For the call option, I have the alert set at 50 cents per share. For the put option, I have it set at 10 cents per share. The reason why I have it set on the put and the call is that if the put is in the money, the value of that option will never go to zero. So how would I know if the time value is basically gone? Well, that's where the call option comes into play. See, if the value of this 170 call option gets below 50 cents per share, I know that 170 put option is deep in the money. And so there's only 50 cents left of extrinsic value in this call option. I know it's probably time to check out my put option at that same strike price to see if I should go ahead and roll it in order to avoid that option from being assigned to me. See, options generally are not assigned if there's plenty of extrinsic value left in them. It's only when the extrinsic value is pretty much all gone that they're assigned. These alerts are a nice way to keep track of the amount of extrinsic value in a position. As long as there's still plenty of extrinsic value in those put options, they probably won't be assigned to you. I like to see at least 20 to 30 cents of extrinsic value in a put option, and if it's less than that and I don't want it assigned to me, then I consider going ahead and rolling it. Now, if it's a more expensive stock, you probably want to see at least 50 cents per share or so of extrinsic value. Now, I mentioned that I rolled that November option out to February. Why did I go that far out in time? I mean, that's 3 months out in time, and I like to sell shorter term frame options. I like to sell them when they have expiration day between 20 to 60 days. So why did I go out to February? One reason was to get a credit there. Notice up top here that it cost me $5.70 to buy that November 180 put option back. And I got just 5 cents per share more than that when I sold the February option, because you see it sold for $5.75 per share. So that's one of the main reasons why I went so far out in time. But going back to our annualized return, that might be another reason why you sell a different expiration day. For example, here you see the January 170 put options. Well, the annualized return of that option is about 7.9%. So what's the February return? If we got the same 170 strike price, notice it's a little bit higher. It's at 8%. Well, what about May? Should we go out to May? As you see, as I stretch the column out for you, it's at 7.33% annualized. So indeed, the highest return is this February 170 put option. Because I was able to walk away with my new friend, the nickel, put it into my pocket, and get it down to 170 per share, I went out to February. It just so happened that was the best return as far as the next several expiration days for Hershey. Now I want to give you a couple of bonus tips that will help you when a position has gone deep in the money on you. Let's say, for example, I couldn't get enough out of this February option to fund rolling this November 180 put option down as I rolled it out. I will still walk with a debit. What if I had position sizing available? I could consider adding to this position. So what that would have looked like is I would have bought the November option back. Say I would have bought one of the put options back and sold maybe 2 of the Hershey February 21st 170, or maybe even I'd be able to go down to the 165 or 160 put option and do that for a credit. Now I have a hard and fast rule. I will only do that if I have position sizing available. As you probably know if you've been watching my channel for a while, I only want to have at risk 5% of my maximum portfolio in any one position. So if all my Hershey put options were assigned to me and that was less than 5% of my overall portfolio, I would consider adding this position by selling more cash cure put options if it helped me roll that put option out as I rolled it down for a credit. But if I don't have extra position sizing available, I will not do that. And here's another bonus tip you might consider when you're rolling a put option that's gone against you. Here you see a position I have right now where I've sold some put options in CAG. I've sold the December 20th $28 put options. And as you see here, because it's in pink, this option's in the money. So this position has gone against me to some degree. Now it's not a big problem because it's trading for around $27.59 per share. But let's just say I no longer felt comfortable being in a cash cure put option in CAG. Something had changed fundamentally with the company, so I didn't like it anymore. How could I deal with that? I could indeed just buy this position back. Right now it's showing I have a loss of about $344. But how can I turn that into a positive? Remember, we're option traders. We're kind of like superheroes. We can do things that normal traders can't do. So what can I do with this to put it back in my favor? Well, I could buy the CAG December 20th $20 put option. It cost me about 85 cents per share, as you see here. Now, how do I turn this into a positive? Well, here's what I might consider doing. I might consider doing something like when I buy that CAG position back to close it out, I then sell a position in a stock with a similar price. And here's one, UGI, that I like. Now remember, that CAG position is trading for around 85 cents per share. So we need to replace that cost. We need to find something we can sell for around 85 cents per share and a company we like, who has good fundamentals, whose technicals are looking good. Well, this could be a possibility. Here we see UGI. If we go out to January 17th, we felt comfortable selling the $30 strike price put options. Notice they're selling for above that 85 cents per share. You just want to make sure you feel comfortable owning the stock at that price. Now, personally, I wouldn't do this trade for two reasons. Number one, I'm okay staying in CAG. I feel like the company's still fundamentally solid. And number two, so I've been telling my patrons that I believe UGI has been undervalued. And finally, the market saw it my way. In fact, over the past week, UGI has had a 22% increase in price. Now it's kind of leveling off and maybe coming back down with this down candle on Friday. So because of that, I would not feel comfortable selling this $30 strike price put option. But I think you understand the concept. You buy the put options back in the company you no longer believe in fundamentally, and you sell a similar strike price put option in a company that you like, that you believe in fundamentally. And hopefully that company is at least fairly valued, or even better, undervalued. UGI was undervalued when I was preparing for this video, but when I went to record it, it actually went way up in price, so now it's more fairly valued. But you get the idea. Swap one you don't like for one you do like. Another tip I want to share with you is how to decrease your risk when you're selling put options. At some point, every so many years, we have a big sharp decline like what happened in 2020 and then also 2022. So how do you protect yourself when you're selling these put options? Yes, we can improve our positions by rolling them, but how do we give ourselves a little bit of protection? I wanted to share this little tip with you. Instead of selling a cash or put option or a naked put option, why not consider doing bullish put credit spreads? Here you see I'm doing that in my small option trading account. This is a small account. It has less than $50,000 in it. It's one that I share with my patrons. And here you see I did that. I sold the 221 put option and I bought the 220 put option for protection. So my max loss is that $1 per share minus the 26 cents per share that I got for selling the spread. But by buying that put option, that 220 put option, it gives me some protection. It caps my max loss. So if you're selling put options, why not consider buying some put options for protection against the ones that you're selling? This leads me to another bonus tip I want to share with you when you're selling put options, and that's be careful around earnings. Here you see Target. It's a company probably most of us know really well. Maybe our families even shop at Target. But notice what happened after earnings about a week and a half ago. This stable company dropped over 20%. That's why I don't really like selling put options through earnings if I can avoid it. So just keep in mind that when you trade through earnings, you're adding risk to your position. That's why you tend to get more for those option premiums that expire right after the earnings announcement. So just be careful around earnings. Earnings can be very volatile. They can hurt your cash or put option positions. Now, I know this video is about when and how to roll a put option, but I want to answer the question, when should you not roll a put option? Well, there's a lot of reasons why you wouldn't roll it. But one of the big ones to me is when there's still a lot of extrinsic value left in a position. Now, here's the trade I was in that actually went against us. Now, it's improved since then, but it has gone against us from where we entered this first initial cash put option trade. Let me show you what I mean. Here's the spreadsheet I keep track of all my put options, profit and loss, and all that good stuff. So on September 19th, I sold the FSLR October of 24 210 put option. Well, unfortunately, as you see here, FSLR traded on Friday when the market closed at $199 per share. So as you see here, on October 17th, I rolled this put option out as I rolled it down. This is the candlestick for the day when I rolled this option. Notice that FSLR was trading for right around $202 per share. So that 210 put option was about $8 to $10 in the money. Now, several days before that, I had my patrons ask me, Randy, what are we gonna do about FSLR? My reply is, at this time, we're not gonna do anything. And the reason that there was still plenty of extrinsic value left in that put option. So I wanted to give the option a chance for that extrinsic value to burn off it. Remember, every day, some of that extrinsic value tends to get burned off the option. That can help you roll a put option. That theta or time decay that eats away the value of that option, it can help you roll that option out as you roll it down, as the extrinsic value is almost all out of the option. If there's still a lot of extrinsic or time value in an option, I'll consider sitting on it, especially if I think the stock might have a bounce. Because of all the extrinsic value that was still in this option, even though it was going against us, I waited until October 17th to roll this put option. See, all this time back in here, even though it had gone against us, there was still a ton of extrinsic value in that put option. So I wanted to let that dissipate before I rolled it out as I rolled it down. and we were able to get it down and out to the January 17th 165 put option. We put a credit in our pocket. As you see, as of right now, this put option has gone our way. We're actually up in this position $554. So we'll see how it turns out over the next 47 days. But if an option still has a lot of extrinsic value, many times, especially if I think there might be a bounce back in my favor, I'll hold off on trying to roll that option out as I roll it down. I'll let some of that extrinsic value burn out of the value of that option. Selling and rolling put options is one of my favorite ways to consistently put cash flow in my pocket every single month, as you see here on my cash flow spreadsheet. If you'd like to get an alert whenever I buy, stock, or sell options, check out the benefits of becoming a patron down at the link in the description below. One of the common questions I get asked a lot is, especially when it comes to the end of the year, is, Randy, how does rolling options affect my taxes? I addressed that question as well as the wash sale rule at the video at the link above. That video is entitled Wash Sales. What are they and how can you avoid them? Until next time, happy investing, and we'll see you again soon.